Olumide, thank you so much for joining us. Of course, we continue to talk about the coronavirus outbreak, and clearly it impacts the oil market. There are now talks of steeper cuts. But I think one big takeaway from this conversation for me is that OPEC Plus is bent on keeping that oil price certainly above $50 a barrel, perhaps even more. Do you get the sense that come what may, whatever is the outcome of this meeting, we would see a significant enough cut to keep it at those levels?
All right, so OPEC Plus, prior to this time, has been supporting the market with all the cuts. Last year, December last year, there was 500,000 barrels per day cut, bringing overall cuts in the agreement to 1.7 million barrels per day. When you add in Saudi Arabia's voluntary 400,000 barrels per day, that comes to about 2.1 million barrels per day. And in January, you saw some impact from that. Numbers reported by OPEC were a lot lower than they were in previous months and previous years. The impact of the virus has been pervasive so far, cutting demand from China and, of course, the rest of the world, supply shocks all over the world. You get the sense that OPEC thinks it's necessary to cut, and they met earlier this month in February 4 to 6th, and decided that it was necessary to cut further. Initially, there was a proposition of about 600,000 barrels per day, but you get the sense that a cut of a higher magnitude is required at this point. You see prices at some point last week, prices were around $48, $49 per barrel. And you realize that OPEC knows we cannot sustain things this way. And so they will probably want to do something in the region of, I think, about 1 million barrels per day rather than 600,000 barrels per day.
So is that what you expect?
I expect about 1 million barrels per day, at least to manage the market for the rest of the first quarter and into the second quarter. There is also propositions that they will extend the cuts beyond Q2 into the rest of the year. That was what I expected anyway from the beginning of cuts in January. They were going to extend the cuts beyond the first quarter and into the rest of the year. And that's happening now because of what we call the black swan events that's happened with the coronavirus.
No, clearly this is an event that needs this type of reaction. Right. But you just mentioned 2.1 million in cuts previously, and now potentially there are going to be further cuts. Would you say that OPEC Plus is fighting a losing battle, so to speak? The oil supply and the demand and supply dynamics globally simply just point to a lower oil price.
We realize that the fundamentals are changing. I mean, the fact that supply from OPEC is reducing allows the rest of the world, non-OPEC producers, particularly the US with shale, to grab more market share for themselves. You see shale output increasing significantly since about 2014, up till this point. And then you get the sense that OPEC is doing a lot to ensure that at least they still have prices at a good enough level.
Now, I understand the reason for that. The stability of several economies are linked to this. If you think of Russia, think of Saudi Arabia and so forth. But I still just get that feeling that OPEC Plus, so to speak, is simply just buying time to be able to transit away from a dependency on oil. That it is just something that will eventually manifest in terms of.
That's the point. It's something that will eventually happen.
Yeah.
But then what's the option? What's the alternative? The alternative is that you let the prices find a natural balance, and we've seen that happen in the past. In 2014, when OPEC decided they were going to do market management, prices fell as below $30 per barrel. And of course, for the fiscal balance of all the countries involved in OPEC, that wasn't good enough. Saudi Arabia requires about $80 per barrel to balance the books. Nigeria has $57 per barrel for this year. So you look at all of that and you realize we had to do something to ensure that prices at least have a floor so that we can do well, at least at the very.
Okay, so let's talk a bit about some of the earnings that have come out of Nigeria, and I'll start with the downstream companies, and I wanted to get your perspective on what this lower price could mean for them, because now there have been reports that the pump price of petrol should actually decline because the price of oil has come down so much. I wonder if you agree with that sentiment, and what could this potentially mean in terms of higher margins for these producers?
Ordinarily, when you look at the pricing template that the BPPR has set out, when crude prices are lower, you expect that the price of the refined product, which is PMS primarily, should also reduce. Yes, you will see some element of that, but what's the quantum of decrease we would find? I don't think it's a lot, right? Last year, prices relative to 2018, prices were lower last year. And then you didn't see so much of that impact in the revenues and the bottom lines of these companies. You see, a lot of them grew revenues. However, when you look down to the bottom line, for instance, Adova just released full year results, and then you saw increase in revenue of over 31%. Yet, when you go down to the bottom line, you realize that when you unpack the bottom line, yes, there was an increase of about 555% to 3.9 billion. However, when you unpack it, you find that it was one of items that actually buffered bottom line. You look at Mobile reported lower earnings relative to 2018. You look at pretty much all the others.
But quickly, would you say the market conditions are getting worse or better, if at all, for the downstream players?
As far as I'm concerned, it's getting worse. Look at cost.
And is that simply because of OPEC, or are there other factors here for you?
It's largely the direct cost, the cost to sales. The cost of getting the product which the retail. Cost to sales for Adova was about 93.6%. Prior to this time, it's about 91%. For Mobile, cost of sales also increased. For Total, cost of sales, you look across the industry, that's the general sentiment that you get, that cost of sales increase. And if that remains the way it is, and you expect that to probably remain, like I said, there's not much of an impact that lower oil prices at this point will have on the cost of the refined product. And if things remain that way, I mean, it's going to be the same sentiment going forward.
Your reaction to the plans for the company that used to be known as Mobile Oil, 11 PLC, to delist from the exchange? I know it's not something that many people welcome, because we're actually hoping more companies list on the exchange. But what's your takeaway from that? Is there simply a manifestation of a private transaction, so to speak, because of the new shareholding?
Okay, it's not something we expected as well. I mean, it came as, well, it shocked a lot of people. However, you get the sense that the moment private owners take over a company, there might be other things in the offing. NIPCO took over in 2017, now has about 77%. Why keep it on the exchange when we can do things that we want to do behind? Last year, they acquired Lagos Continental Hotel, and then a lot of money would have to be expended in renovating the hotel and getting it up to ship, right? And that would have an impact on their books for this year. When you look at that, it's possible that their stock price takes a beating this year because of the significant amount of money that they will have to expend in doing that. When you put all of that together, you just want to probably do your things behind and not. You see, a lot of companies are trying to get off the exchange so they can keep their hands in so many other things, so that they don't have to
very quickly
be under the regulatory.
From what we've seen in terms of the results so far and what you're expecting, is there anything that is attractive in this sector right now, downstream petroleum? So taking out Seplat, of course, which is upstream oriented.
Yes. The fact that Nigeria is still growing makes the sector attractive. I must confess, makes the sector attractive. It is important that.
But the fundamentals of the business, you're putting
the real challenge, as far as I'm concerned, is the regulatory environment. As long as that,
but that hasn't changed.
As far as that is fixed, yes, there were signs that things might change last year, and hopefully we might be able to get some of those new regulations out there very soon enough. If we get those regulations out there, put them in place, and we implement them the way that we should, I think that it is still a sector that holds promise. But things as they currently are, it doesn't pose to a very attractive sector.
All right, thank you so much for sharing your perspective this afternoon. Olumide Ibikunle, senior analyst at Meristem Securities, giving his perspective on the oil market and, of course, the companies listed here on the NSE.